welcome back to another episode of Go Baby Go TV. I'm Louie Hillman, joined by my partner, the Optimist guy, Brian Setzler. What's up, Brian?
Hey, everybody. Hi.
Today we're talking about the premium finance problem. Brian, we've talked previously about the spike in interest rates. Well, we're now seeing a direct impact in the life insurance industry, and very specifically, premium financed, bank financed life insurance policies. What's going on right now?
Well, the existing transactions, and let's talk about what is the bulk of these transactions. What are a normal thing we would see? Large life insurance purchases many times were financed using bank financing. The idea was to borrow the money to pay the premium as opposed to paying the premium directly, right? And part of the reason it became very popular over the last decade was because interest rates were quite low. And so you would multiply the loan essentially times the expected interest rate, and that equals your expected client outlay. So for example, if by year 5, your loan is $5 million and your loan interest rate is 3% of $5 million, that means the client's expecting to pay 3% of $5 million, $150,000 a year, right? Well, now that the loan interest rate has increased from 3% or less to 7% or more, then that changes the mathematics quite a bit. Now, instead of 150,000, now that's 350,000 plus the increased loan. And the projections would be that now it's dramatically impacted the expected client outlay costs associated with the purchase of their life insurance.
Yeah, and the vast majority of loans that happen in this transaction are renewed every year. So the rate is renewed annually. You can lock in a guaranteed rate, but that came at a higher cost, so most people don't do it. So we worked on a case earlier this week where the client's rate had renewed in just 1 year from 3% to over 7%. And obviously drastically changes the scenario in terms of what the client expectation is.
Yeah, that's really the core problem. What the client expectation is the way you said it is correct. The clients feel misled. The psychology becomes buyer's remorse would be the phrase, right? They regret that they did it this way. They go to their agent and they say, what can we do to get out of this? They were perfectly happy a year ago. Now all of a sudden they want out. Even though most of the time the agents explained that the loan interest rate was not guaranteed, it's at the mercy of economic conditions. Regardless, no one expected the Federal Reserve to raise interest rates this much this quickly. And the consequence is it's caused some unexpected problems. Last week we talked a little bit about bank failures. This would be similar in that the rate moves so quickly it would change the buyer expectation. And now premium finance is not less expensive than other alternatives, like the one case we looked at this week, Louie.
Yeah, and when premium finance is modeled, usually there's a slow ratchet up of the interest rate expectations, right? There's a stress test, so to speak, of showing increasing interest rates. But I mean, those are usually in 25 or 50 basis point annual increases, not 4% in 12 months, which is historic,
That's a big shock to the system, And the thing is, I've talked to some professionals in the area who are getting paid consulting fees for the purpose of evaluating existing premium finance transactions. They're telling me that they're seeing every single day more than one transaction way, way up in the multi-millions of dollars of loan where the client never even planned to pay any interest payments. They just borrowed all the money. All right, so that just means now that the rate has changed, that loan is compounding at a much faster clip because the rate changed. And the shortfall, meaning the difference between the cash value and the total amount of that loan, is jumping to the point where it really makes those transactions look like whoever designed them intended to hurt somebody. They didn't, but it makes them look that way.
Yeah.
That's the negative, you know?
Yeah, and because the transaction is based on the expectation of arbitrage, which was easy if the interest rate or the borrowing rate is 3, right? To expect that the policy to outperform that by quite a bit. But when the borrowing rate is now 7, the mechanics of how the crediting works does not guarantee the return to exceed the cost of borrowing.
Yes, and the kind of products that they were using were not the lowest cost products. That's the thing people totally didn't pay any attention to. My criticism has simply been that they were using products that were the most expensive products. And the reason they were using them is those products were built really for tax-free retirement, but then they used them for premium finance. They were not low-cost permanent contracts. And the reason they did that is they needed the cash values to build more quickly in the beginning. They needed to try to outperform the cash value, needed to outperform the loan rate, like you just mentioned. But now that the rate has changed, it makes it very impossible for that all to work out. You know, the good news is there are solutions that exist to rescue some of the transactions. In many cases, they just have to ride it out, unfortunately. What if the person's health has changed, for example, and now they're uninsurable? You know, that's a tough one. But if people in their 50s and 60s and perfectly healthy, I do think there are a number of ways we can modify the existing plan to offer extreme benefits, like the case we looked at this week. It cut the client outlay in half. That's a pretty big deal.
Yeah, let's just talk through that at a real high level. It's a 54, 55-year-old individual, $10 million of coverage, $2 million bank loan, and the accumulated cash value is about 2.6 million, right? So we see some growth on above the money borrowed. But with the renewing interest rate over 7%, the client's now looking at a jump from like 60 some thousand dollars in annual interest charges to 150,000. Talk us through thought process and reviewing that and helping eventually present a rescue of that plan.
Well, looking at it, not only is the current outlay scheduled to be 150,000 a year, but it's going to go up each year with the additional premium that's borrowed, right? So it's 150 and then it'll continue to stair step upward. So that's way more of an outlay than what the client ever expected to pay. We can extinguish the bank loan, recapitalize the whole plan, like redo it. And we were able to come up with an 80,000 a year outlay for 15 years, level outlay, not increasing. And certainly ended up at life expectancy to have vastly greater than the 10 million. So that is a slam dunk. You know, not all are that easy to solve, but that one is great. So we've eliminated a $2 million and growing loan risk. We set the client outlay to really, it was going to be less expensive than what they ultimately had planned to pay originally, but dramatically less than where they are now. Certainly.
Yeah, and the advisor has an opportunity to look like a hero to that client.
Oh yeah. In fact, you know, the advisor could say, look, this premium finance thing worked really well over the last 6 or 8 years, but now it's time to pull the, you know, jump cord or whatever, the exit button, and let's take our winnings and redo the transaction and move to something less risky now that we've seen. And, you know, no one could have foreseen a 4.5% jump in rate in a year. That's ridiculous. The Fed has never done that before. You know, it's causing problems.
Well, if you're watching this and you have an opportunity that is worth a look, we'd be happy to help you with it and be of service. Bryan, as always, the conversations are insightful. Here every Monday to rev up your week and turbocharge your sales. Make it a great day.